Welcome back. Well, investors, as always, are assessing how inflation data from the U.S. and also the UK will affect the outlook for interest rates. Our next guest says that after the January jobs report, it was a blow-away jobs number, and CPI reports in the U.S., where inflation came in slightly stronger than expected, the U.S. Federal Reserve Board doesn't have a whole lot of choice but to hike rates at least 2 other times. Joining us to talk about how far the U.S. needs to go and whether the Bank of Canada may need to backtrack on a tentative promise to hold rates steady is Andrew Pyle. He's Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Thanks a lot for coming in.
Good to be here.
Great to see you again. Okay, your view on the Fed then. We have seen a remarkable jobs report in the U.S., also in Canada. Let's stick to the U.S. for the moment, though. 500,000 jobs created and change, and CPI coming in stronger than economists had forecast. What does that mean to the Fed, and what does it mean to the markets?
Well, I think it tells us right now that we're not getting a recession in the first quarter of 2023, Paul. And if you look at the retail sales numbers for this morning, that would reinforce that view that whatever weakness that's taking place in the U.S., and there are, there's spots of weakness, it's not broad-based, and definitely not broad-based enough for the Fed to start taking its foot off the brake pedal. And I think the inflation data signifies that we are not out of the woods yet. We're not going to get to 2% anytime soon. And I think that basically is going to support the Fed in at least 2 more rate hikes of 25 basis points each before we get to any form of pause or notion of pause from the Fed.
You said in some recent commentary, picking up with what you just said, it's extremely doubtful that the Fed transitions to rate cuts by the end of this year, and this is going to have to be acknowledged by equity bulls at some point. That sounds like you calling these markets overvalued.
Well, I think they're overvalued right now. I mean, because there's 2 parts to this, Paul, right? One is the Fed going to keep raising rates? I think we're probably going to see at least 2. The second thing is, when does the Fed feel comfortable enough to make that pivot in language to a transition to cutting rates? Well, you're not going to cut interest rates in an economy where we've got 500,000 jobs being added at the front end of the year. Tight labor markets, the claims data supports that as well. And inflation, services inflation right now that's running at 7.1% and still accelerating. So I think right now the equity market, if they're thinking they're going to get rate cuts anytime soon, that's going to be, it's going to have to be priced out. And I would say pretty soon, because equity market is supposed to be forward-looking, right?
One thing the bulls point to is at least a moderate easing in wage growth, which can be seen, of course, as a leading indicator of inflation, because wages ultimately get built into prices.
Yeah, it's a great bedtime story, Paul, to say that wage inflation is starting to moderate. But keep in mind here, if we're adding more jobs, and it's not that wages are not going up. Wages are going up at a moderated pace, but we're building an aggregate demand base in the States right now that is pretty substantive. And if we're talking about residual cost pressures that are in the system, from commodities to everything else, the ability of a retailer to pass that price or cost on to the consumer gets better when aggregate demand increases on the macro level. And I think that's what we're seeing right now.
The Canadian market, what's your outlook here?
Canadian market right now, I think, can hold in a bit. I think energy prices right now are bottoming. Nat gas prices, as you know, Paul, have plummeted in the last few weeks. I think we're reaching a bottom there. I think oil prices have bottomed. With China reopening, I think energy does well. I think that gives support to the TSX. The key thing is, what does the Bank of Canada do? And does the Bank of Canada follow the Fed or hold still or hold true to its, we're going to just pause here and let that go? If they do, Canadian dollar will weaken, which is probably not bad news for the TSX as well.
Interesting to hear you say that you think crude oil prices are bottoming. We could bring up a 1-year graph, and certainly the price of crude oil in New York has bumped, has touched 70 and change about 3 times since November of last year. There you see the bump up against $70 and change. You see stronger oil prices ahead, and it must be said, we've had Suncor Energy today report results that are remarkable in terms of their increase in profit and cash flow on the back of crude oil prices in the fourth. You can see where they were in the fourth quarter. They're about $80, still well below the high in that graph.
Yeah, we're encouraged by oil. I mean, the fact that we've hit the support level 3 times now, it's held. We do have the China reopening story, which is going to be positive for crude. And we're going into March right now, Paul. So March, April, May, we're going to get back into the summer driving season in the States, and that's going to give us another demand push. So I think we could see crude getting back up to about $90 a barrel. And again, from a Canadian perspective, that's not going to be bad news.
What kind of equity market exposure do you advise for your clients right now?
Well, right now we're going back in energy. We're looking for good dividend names. We've been adding money to, say, Enbridge, TC Energy, places where, investors are going to get a good 6% dividend yield in what has been a fairly depressed energy market that we think is going to improve.